This is Mike Carr. Thank you for joining me for another in-depth look at a technical indicator. Today, we're going to dig into the MACD, a very popular indicator. The questions I want to answer in this video include what I think are the most important questions for traders. We're going to look at what is MACD, how it's used, and most importantly, we're going to address the question of does it work? And by does it work, I mean can you follow this indicator to beat the market? Let's start with a look at what MACD is. It's formally named the Moving Average Convergence Divergence Indicator. And it's basically the differences between two moving average, and the interpretation of the indicator involves looking at whether the moving averages are converging towards one another or diverging away from one another. This is one of the many indicators that was developed in the late 1970s when exponential moving averages were considered to be the next best thing to work on in market analysis. And a number of these analysts were looking at EMAs because they're more responsive to the price action. So you don't have the lag that you do with the simple moving average. Now, when calculating MACD, you can use an exponential moving average or a simple moving average. The results don't really matter in the long run. Some signals will be better with one moving average, some better with the other. In the very long run, they all even out, and it just doesn't matter. So to calculate it, we're going to look at putting just step by step how to do this. And we're going to add moving averages to the price. I'm just going to use the default settings. So we have a fast moving average and a slow moving average. And in this case, the fast is a 12 period, the slow is a 26 period. And an uptrend is defined as times when the fast is above the slow. And this is the same for all interpretations. So on the left side of the chart here, we see a downtrend, and on the right side, we see an uptrend. The next step is to find the MACD line. That's the difference between the two moving averages. So we're going to subtract the value of the 26 period from the value of the 12 period, and what we see here is that values above 0 indicate an uptrend, and below 0 we have a downtrend. And all this is then, the line is the difference between the two MAs. To get signals from any type of indicator, we can add a moving average to that line. So the signal line, the dashed line here in this chart, is a 9-period moving average of the MACD. That's all it is. Now you usually see it in terms of a histogram, and this charting style uses just red and green rectangles to show what the signal is. So red indicating a sell signal. Here we see the fast below the slow, so that's a sell signal, and that's all that's required to interpret and to calculate the MACD. Now, it can be interpreted in a number of ways. Crossovers or breaks above the 0 line on the histogram can give you a buy and sell signal. You can also use divergence analysis. Divergence analysis means, let's say that prices are rising while MACD is falling. They're diverging from each other. We would expect that, well, momentum is slowing. That means traders aren't working enough to keep the trend intact. These are appealing on a logical basis. In a future video, we're going to test divergences and see if they actually work. And we're going to do that across a number of indicators because this type of analysis is so common, but we don't want to just do what everyone else is doing. We want to put the data to the test, and we'll look at divergences later. Right now, let's look at MACD. And what this is showing us is back-tested results for all the stocks in the S&P 500. So right now there's 505 symbols in the group. And what I used was the historical components at the right times. And here's your results. Returns look great. Win rates just below 40%. That's typical for a trading strategy that follows trends like MACD does. So the 40% win rate, very typical on a diversified trading basket of stocks. So if you wanted to follow this and you wanted to pick 20 to 30 stocks and take all the signals in those stocks, these are the kind of results you could expect. Here's the problem. The maximum drawdown, you would have lost 88% of your money if you followed all daily signals over the last 20 years. Over the full period, you would enjoy market-beating returns, but at one point, you would have lost almost 90% of your starting account balance. So risk is maybe too high for most of us to accept on trading individual stocks. So I also tested it on the SPY ETF. This tracks the broad stock market. Win rates again around 40. You're not going to see deviation from that too much in a soundly built trend following system. Returns here lag the market. That's because an index won't have enough volatility to give you really big gains on its own. So if you're just trying to trade one ETF, you're going to have a very difficult time beating the market with any single indicator. You're going to need a more advanced strategy than that. Maximum drawdown, meaning what's the worst risk? Daily, still too high, 67%. Buy and hold, 56% over this 20-year period. Weekly, only 27%. That tells us that a longer-term signal can help us manage risk. This chart uses a monthly signal. So we have a monthly MACD. Let's say we get out completely when the signal is a sell. Here you have a 52.9% win rate. That's extraordinary for a trend following system. Of course, you're going to wait till the end of the month to take your signal. So you're not trading very often. Annualized gain, 4.7%, still lags the market, but your drawdown is reduced to just 16.3%. This is a risk that's manageable. If your worst case risk is less than 20%, you have an outstanding trading strategy, and that's worth looking at in detail. So the monthly MACD could be very useful, and it could be kind of help me avoid the worst of the market. Is MACD worth using? Yeah, as a risk reduction tool. As a standalone indicator, risk is too high, but when we factor in monthly data, maybe we could look at just don't buy when MACD's on a sell signal for the broad market. Let cash build up in your account. Or add put options when MACD is bearish. There's a lot of value in this indicator as a risk management tool, but not as a complete trading strategy. So as we're going to see with a lot of indicators, they're not worth taking every signal, but they can be bundled into effective strategies. And that's it. That's our look at the MACD. I hope you learned the answer to the questions that you had. Hopefully by now you understand what MACD is. More importantly, you understand how to use it, and you know whether or not you should use it. Thanks for joining me.